Welcome to this explainer. You know, we all track those daily ticker symbols and the breaking news, right? But today, we're totally stripping away the noise to look at the pure underlying mechanics of wealth building. We're getting right back to the absolute fundamentals of exactly how capital compounds in the market over time. Let's dive in.
Just imagine taking a single $100 bill and investing it today. By itself, it's maybe enough for a nice dinner or some new clothes, but the moment you deploy that cash into the market, it literally stops being a static piece of paper and instantly transforms into a highly dynamic financial tool.
Now fast forward 20 years, and that initial investment can grow into thousands of dollars. It sounds like magic, right? Turning a single $100 bill into thousands without even clocking into a job to earn the difference. But honestly, it's not magic at all. It's mechanics, and those are the exact mechanics we're breaking down today.
Okay, here's our roadmap for today. We're going to cover the magic of investing, the mechanics of a share, what actually drives stock prices, bulls, bears, and profits, and finally, those common beginner mistakes you absolutely need to avoid.
So, Part 1, Mechanics of a Share. Before we dive into the complexities of the global economy, we really have to start with its absolute smallest building block. It's so easy to forget when you're just staring at a flashing red or green ticker symbol all day. But a share is literal ownership. You aren't buying some digital abstraction, you're buying a fraction of a real, breathing business, like Apple, for example. You own a tiny percentage of their factories, their intellectual property, and their future cash flows. The fundamental logic here is pretty unbreakable. If the underlying company produces more value, your slice of that pie inherently becomes more valuable.
And here's how that ownership actually reaches you. Basically, a private company decides they need to raise massive capital to build new factories, or say hire top-tier engineering talent. To get that massive influx of cash, they offer equity to the public through what's called an initial public offering, or IPO. This is that precise moment a business transitions from being tightly held by just a few founders to being owned by a massive global pool of public investors.
Moving on to Part 2, what drives stock prices? Now that those shares are out there trading publicly, what actually causes them to constantly tick up and down every single minute of the day?
Well, stock prices are ultimately driven by the fundamental tension between demand and supply. But what actually pulls those levers? It's this fascinating collision of hard mechanical data and, frankly, volatile human emotion. On one hand, you've got cold mechanics, right? Things like quarterly company earnings, revenue growth, and interest rates set by central banks. But on the other hand, you have psychology. A single breaking news alert or a sudden wave of panic can cause massive price swings in literal minutes, even if the underlying fundamentals of the business haven't changed one bit.
All right, Part 3, bulls, bears, and profits. You see, these constantly shifting prices create broad market environments. It's kind of like the weather of the financial world. Sometimes it's sunny, sometimes it's stormy, and you have to know how to navigate both.
So a bull market and a bear market aren't just directional trends where prices are rising or falling, they are entirely different psychological states. In a bull market, prices are up and optimism is just contagious. Capital flows freely, growth is the priority, and investors aggressively buy the dips because the prevailing belief is that tomorrow will inevitably be better than today. But a bear market? That's the exact inverse. Prices are falling, pessimism and fear take hold. Preserving your capital becomes the ultimate priority, and basically every rally is met with intense selling pressure. Mastering the market really means recognizing exactly which psychological environment you're operating in at any given moment.
But look, regardless of whether the bulls or the bears are currently running the show, the ultimate truth to wealth building is committing to long-term investing. The market is absolutely going to have severe down periods. Bear markets and corrections are honestly just a necessary mechanism to flush out excess. But historically, over the span of decades, the overarching macroeconomic trend has always been growth. Taking a long-term approach allows your capital to just weather those short-term storms and ride the broader upward trajectory of human innovation.
And over that long term, your wealth is primarily built in two distinct ways: capital gains and dividends. Capital gains are the classic scenario we all think of. You buy a share for 50 bucks, you hold on to it, and eventually you sell it for 100. Simple enough. But dividends? Those are the silent engine of true compounding wealth. When a mature company generates excess cash, they often just wire a portion of those profits directly into your brokerage account, rewarding you simply for holding the stock. When you combine those capital gains with the compounding power of reinvested dividends over, say, 20 years, that's how you achieve that exponential growth we talked about at the very beginning.
Which brings us to our final section, avoiding common beginner mistakes. Because, let's be real, understanding how to build wealth is only half the battle.
knowing how to protect it from yourself is just as important.
Even the absolute smartest investors can self-destruct if they let emotion take the wheel. Think about the classic life cycle of a failed trade for a beginner. It usually starts with FOMO, the fear of missing out, which pushes someone to buy a highly hyped stock at the absolute peak of its valuation. Then, inevitable volatility hits, the price dips, and instead of holding, they succumb to panic selling, locking in a devastating loss. Combine that reactive, emotional behavior with a deeply flawed portfolio that has zero diversification, or simply investing blindly without doing any research, and you have a perfect recipe for destroying your capital.
As the source material so perfectly puts it, the stock market isn't a casino. It's a robust mechanism where patience, rigorous knowledge, and unwavering discipline combine to build generational wealth. It's not about pulling a lever and praying for a jackpot. It is about securing ownership in real, productive businesses and just letting time do the heavy lifting. So now that we've demystified these underlying mechanics and exposed the magic as pure logic, how will you use these tools to construct your own financial future?